As we move through February 2026, a silent revolution is happening inside the world's most powerful vaults. For decades, the US dollar was the undisputed king of global reserves, but in the last 30 days, that foundation has begun to crack. Central banks are undisversifying anymore. They are actively ditching the greenback at a rate we have unseen in 70 years. From the BRICS nations slashing their dollar holdings to below 57%, to Germany and Italy exploring the repatriation of their gold from New York, the message is clear. The era of unchallenged trust is over. We are no longer just looking at a currency shift. We are witnessing the de-fiatization of the global economy, where sovereign nations are trading paper debt for hard assets. This isn't a forecast or a prediction. It's an observation of what is happening right now, behind the closed doors of global finance. The ground is shifting beneath our feet, and the next few minutes are about understanding why and what you can do about it. So, why is this happening now? What's the trigger for this great financial migration? The catalyst for this 2026 exodus is a dangerous combination of fiscal dominance and what the market is calling the Warsh Pivot. With Kevin Warsh now at the helm of the Federal Reserve, the financial world has woken up to a harsh reality. The U.S. is trapped between a rock and a hard place. To fund its massive spending initiatives like the One Big Beautiful Bill Act, and to manage a national debt that has ballooned to an eye-watering 120% of GDP, the United States is essentially forced to maintain a weak dollar policy. Why? A weaker dollar makes American exports cheaper and more competitive on the global stage. It's a classic move to stimulate the domestic economy. But for the rest of the world, for the central banks holding trillions of US dollars in their reserves, this policy acts as a hidden inflation tax. Think about it. Why would China, India, or Saudi Arabia continue to hold vast sums of a currency that is being intentionally and systematically devalued to pay off America's domestic debts? It's like storing your savings in a vault that you know has a slow, steady leak. You wouldn't stand for it, and neither will sovereign nations. In early 2026, we've seen the risk premium on U.S. Treasuries spike. This isn't just market jargon. It means the world is finally asking the tough questions. How much longer can the issuer of the world's reserve currency also remain its own biggest borrower? The inherent conflict of interest is now too big to ignore. The trust that once underpinned the dollar's dominance is eroding, and countries are no longer willing to pay the price for America's fiscal policies. They are looking for an exit, and they are finding it in the oldest form of money known to man. The numbers, as they say, don't lie. And the numbers are telling a story of a modern-day gold rush. But this time, the prospectors are entire nations. In 2025, central banks went on an unprecedented buying spree, purchasing a record-breaking 1,100 tons of gold. That's not a typo. Over 1,000 tons of physical gold were moved into sovereign vaults. And this trend has only accelerated. As of this month, February 2026, major financial institutions like Wells Fargo have officially reset their gold price targets to a staggering range of $6,100 to $6,300 an ounce. This isn't just wild speculation fueled by market hype. It's a mechanical shift driven by fundamental changes in the global financial architecture. Central banks are deliberately moving toward a hard money system. They are seeking to protect their national sovereignty from the weaponization of the dollar and the instability of a debt-based system. We've seen this play out with the rise of parallel financial universes. China's cross-border interbank payment system, or CIPS, has already reached a transaction value of 45 trillion yuan. This system operates completely outside the orbit of SWIFT and the U.S. Treasury, creating a powerful alternative for international trade that doesn't require permission from Washington. In this 30-day window, we are witnessing the birth of what experts are calling the multipolar monetary landscape. It's a world where no single currency holds absolute power. In this new world, gold has re-emerged from the shadows to reclaim its historical role as the ultimate, neutral reserve asset. It's the bedrock of trust in an untrusting world. And in this new landscape, the US dollar is slowly but surely being relegated to the status of just another local currency, primarily serving the Western Bloc, rather than the entire globe. The shift is monumental, and it's happening faster than anyone predicted. So, the billion-dollar question, or perhaps the multi-trillion-dollar question is, what does this all mean for you? For your savings, your investments, and your financial future? The most significant development this month is the tangible progress on the BRICS unit. This isn't just another digital currency. It's a gold-backed digital trade currency specifically designed to bypass the dollar entirely in international commerce. Imagine this scenario. If India and Russia successfully settle their massive 2026 energy contracts using this new BRICS system, as is currently being negotiated, the demand for petrodollars will face a secular collapse. For 50 years, the world needed dollars to buy oil. If that necessity disappears, one of the main pillars holding up the dollar's global dominance crumbles. So, how do you prepare in the next 30 days? The answer is to follow the smart money. And right now, the smartest money on the planet's central banks is telling you exactly what to do. The key strategy is to reduce your home bias. The common but risky tendency to keep 100% of your wealth tied up in one currency, one economy, and one legal system. In a world that's de-dollarizing, that's like putting all your eggs in one increasingly fragile basket. Diversification is no longer just about stocks and bonds. It's about diversifying across asset classes, currencies, and even geographies. This could mean allocating a portion of your portfolio to critical minerals, the raw materials fueling the next industrial revolution. It could mean exploring international jurisdictions with strong property rights and a history of financial stability, like Switzerland. And, of course, it means considering a position in assets that act as a store of value outside the traditional system. For many, that includes holding a percentage in digital gold like Bitcoin, which has impressively held the $90,000 line despite the surrounding chaos, acting as a hedge against fiat currency devaluation. The goal isn't to predict the future with perfect accuracy. The goal is resilience. It's about building a financial fortress that can withstand the shocks that are coming. The roller coaster is already in motion, and it's only going to get faster from here. The fundamental question you need to ask yourself is this: when the music stops, will you be left holding the paper, or will you be holding a piece of the vault? Thank you for watching. If you found this information valuable, make sure to like, subscribe, and hit that notification bell so you don't miss our next update on this rapidly evolving story. Stay informed and stay prepared.